let's take a deep dive into Microsoft's balance sheet. The company's cash and equivalents followed a V-shaped trend, dropping significantly in 2024 before rebounding in 2025. The sharp 47.2% decline in cash reserves in 2024 strongly suggests a massive cash outlay, likely driven by large-scale mergers and acquisitions (M&A). Heavy capital expenditures (CapEx) for AI infrastructure. However, cash reserves surged back by approximately 65.1% in 2025, climbing back to over $30.2 billion. This rapid recovery highlights Microsoft's phenomenal cash-generating power, operating cash flow, from its core businesses, showcasing its ability to quickly rebuild liquidity, even after aggressive capital deployment. Now, let's move on to the next chart, which illustrates Microsoft's short-term investments from 2023 to 2025. Interestingly, this chart follows a very similar V-shaped pattern to what we saw with the cash and equivalents earlier. As we discussed previously, this sharp decline wasn't due to poor performance. Instead, it shows Microsoft's aggressive capital allocation. The company actively liquidated its short-term holdings to fund its massive, all-cash acquisition of Activision Blizzard, as well as its historic capital expenditures for AI infrastructure. But look at the 2025 bar. The short-term investments rebounded strongly by over 12%, climbing back up to $64,323 million. This rapid recovery proves how incredibly strong Microsoft's core business is. Thanks to its massive cloud and AI revenues, the company is generating cash so fast that it can aggressively invest billions of dollars and then immediately start rebuilding its financial cushion the very next year. Next, let's take a look at a crucial metric for Microsoft's overall liquidity from. This chart displays the combined total of cash and short-term investments from 2023 to 2025. As we analyzed earlier, this wasn't a sign of financial trouble. Instead, it was a period of aggressive strategic deployment. We can figure out again what Microsoft did. Now, let's turn our attention to inventory chart, which presents a very interesting trend. Microsoft's inventory from 2023 to 2025. While Microsoft's revenue and operating income have been climbing rapidly, their inventory has done the exact opposite, showing a steep and continuous decline for 3 consecutive years. So, what is the strategic insight behind this massive inventory reduction? First, it highlights Microsoft's successful transition into a high-margin, cloud and AI-first business model. Physical products like Xbox consoles and Surface laptops now make up a smaller portion of Microsoft's overall portfolio. Instead, the company is heavily driven by digital services like Azure Cloud and software subscriptions, which require zero physical inventory. In fact, by 2025, inventory accounts for less than 0.2% of Microsoft's total assets. Second, it reflects world-class supply chain management. Microsoft has drastically minimized warehouse storage costs and eliminated the risk of unsold, obsolete hardware. To wrap up, this chart is a textbook example of corporate efficiency. Microsoft is successfully expanding its business scale while leaving a remarkably light and agile physical footprint. Now, let's look at a very interesting and unique chart, which shows Microsoft's short-term debt over the 3-year period. As you can immediately see, Microsoft carried zero short-term debt in both 2023 and 2025. However, there is a sudden spike in 2024, where the short-term debt reached $6,693 million. So, what happened in 2024? According to Microsoft's financial reports, this temporary debt was driven entirely by the issuance of commercial paper. During fiscal year 2024, Microsoft completed its massive $68.7 billion all-cash acquisition of Activision Blizzard, while simultaneously ramping up its huge capital expenditures for AI infrastructure. To optimize its short-term liquidity and bridge any immediate cash timing gaps during these historic investments, Microsoft strategically tapped into the short-term credit market. The most impressive takeaway from this chart, however, is the 2025 bar, which dropped right back down to zero. This means that Microsoft completely wiped out its short-term borrowings within a year. It strongly demonstrates the company's incredible cash-generating power. Microsoft's core business is so profitable that it can borrow billions for a major strategic move, and then fully pay it off almost immediately. Next, let's move on to the chart, which shows the current portion of long-term debt for Microsoft from 2023 to 2025. To give you a quick definition, this metric represents long-term bonds or loans that are maturing within the next 12 months. Therefore, it is classified as a short-term financial obligation that the company must pay off soon. In 2023, Microsoft had $5,247 million of long-term debt coming due. However, in 2024, this figure dropped sharply by over 57% to $20 to $49 million. This steep decline is highly positive. It shows that Microsoft successfully cleared out its maturing obligations in 2024. Even though 2024 was a year of historic capital deployment, including the Activision Blizzard deal, the company faced very low immediate debt repayment pressure, allowing them to focus their cash on strategic growth. In 2025, the figure edged back up to $29.99 million as the next batch of long-term debt entered its final one-year window. But is this $3 billion debt a concern for Microsoft? Not at all. As we saw in our previous slides, Microsoft currently holds nearly $95 billion in cash and short-term investments. This means Microsoft can wipe out this entire upcoming debt instantly at any given moment. Now, let's moving on to the next chart, which illustrates Microsoft's total long-term liabilities from 2023 to 2025. To clarify, this metric includes not just core long-term debt, but all of the company's non-current obligations, such as long-term operating leases and deferred tax liabilities. Now, you might wonder, why are Microsoft's long-term liabilities increasing while its core long-term debt remains strictly managed? The driving factor behind this growth is Microsoft's aggressive expansion in AI and cloud infrastructure. To support the massive demand for generative AI and Azure cloud services, Microsoft has significantly increased its long-term data center leases and infrastructure-related obligations. Furthermore, consolidating Activision Blizzard's long-term liabilities into Microsoft's balance sheet post-acquisition also contributed to this increase. Therefore, this upward trend shouldn't be viewed as a financial red flag. Instead, it represents growth-oriented liabilities, strategic commitments that Microsoft is making today to secure its multi-decade dominance in the global AI market. Finally, let's look at the overview of Microsoft's leverage by examining the total liabilities chart. Total liabilities encompass all of the company's financial obligations, combining both short-term current liabilities and long-term non-current liabilities. Now, a continuous increase in total liabilities might look concerning at first glance. However, in Microsoft's case, this is a clear reflection of aggressive operational and strategic scaling. The jump we see in 2024 was largely driven by the consolidation of Activision Blizzard's balance sheet. The ongoing rise into 2025 is primarily fueled by massive infrastructure commitments, specifically long-term operating leases for AI data centers worldwide to meet the explosive global demand for cloud and AI services. It is also vital to understand the quality of this debt. A massive portion of Microsoft's liabilities consists of non-borrowed obligations, such as deferred revenue from software subscriptions and operational leases, rather than risky financial debt. Given that Microsoft's total assets have scaled up even faster, surpassing $619 billion in 2025, and the company holds nearly $95 billion in highly liquid cash reserves, these liabilities are exceptionally well backed. Now, let's close our balance sheet analysis by looking at book value graph. To give you a quick accounting reminder, book value represents the company's net worth, or total shareholders' equity. It is calculated by taking total assets and subtracting total liabilities. Essentially, this chart tracks the true foundational wealth of the company. As you can see, the trajectory here is absolutely phenomenal. Microsoft's book value stood at $206,223 million in 2023. It then surged by over 30% to $268,477 million in 2024, and continued its explosive growth in 2025, reaching a staggering $343,479 million. This means that in just 2 years, Microsoft added more than $137 billion to its pure net worth. This rapid expansion reveals a crucial insight. Previously, we saw that Microsoft's total liabilities were rising, and its cash decreased temporarily in 2024. But this book value chart proves that those movements were simply part of a highly successful investment cycle. The astronomical net income generated by Azure Cloud and its AI ecosystem is being converted into retained earnings at an unprecedented pace. Microsoft is building wealth for its shareholders faster than almost any other corporation in history. Now, let's look at the driving force behind Microsoft's incredible financial growth by examining the chart from retained earnings graph. To put it simply, retained earnings are the cumulative net profits that a company keeps internally after paying out dividends to its shareholders. It is the ultimate indicator of a company's independent wealth-building power. And as you can see, the growth shown here is nothing short of legendary. In 2023, Microsoft's retained earnings stood at $118,848 million. In 2024, it jumped by over 45% to $173,144 million, and by 2025, it rocketed to a staggering $237,731 million. Think about this for a moment. In just 2 fiscal years, Microsoft has literally doubled its accumulated internal earnings. What makes this milestone even more mind-blowing is the context of what we analyzed earlier. During this exact same 2-year window, Microsoft spent $68.7 billion in cash to buy Activision Blizzard, increased its dividend payouts every single year, and poured tens of billions into AI data centers. The fact that their retained earnings still doubled after all those massive expenditures proves one undeniable reality. Microsoft's core business engines, Azure Cloud, and the Office AI ecosystem, are generating cash at an unprecedented, historic scale. Their inflows are vastly outpacing their massive outflows. Let's look at graph, which presents Microsoft's total liabilities to book value ratio from 2023 to 2025. In corporate finance, this is essentially the debt-to-equity ratio. It measures a company's financial leverage by dividing its total obligations by its net worth. A lower ratio means the company relies less on debt and boasts a safer financial structure. As you can see, the trend here is remarkably positive, showing a steady decline. In 2023, the ratio was exactly 1.0, meaning its total liabilities and book value were perfectly equal. It then dropped to 0.91 in 2024, and decreased even further to 0.8 by 2025. This downward slope is incredibly significant when you recall our previous slides. We noticed earlier that Microsoft's total liabilities were physically increasing over these 3 years. Normally, rising debt would heighten financial risk. However, this chart proves that Microsoft's risk actually decreased. Why? Because their book value grew at a much faster rate than their liabilities, effectively diluting the weight of their debt. A ratio of 0.8 or an 80% debt-to-equity ratio is exceptionally conservative and healthy for a mega-cap tech company, especially one undergoing massive capital expansion.